Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial mysteries of companies. And today we're looking at Caro Holdings, a company that's definitely, well, interesting. You know, they say the devil is in the details, but sometimes the devil is just really bad at accounting art. Let's dive into their latest report and see if Caro Holdings is flying high or falling fast. So what we have here is their annual report, basically their yearly checkup. It covers their fiscal year that wrapped up on March 31st, 2025. Now this report tells us a lot, but the real story, as always with these filings, is buried in the numbers. They're classified as a non-accelerated filer and a smaller reporting company. This basically means they're not a giant corporation and they have fewer rules to follow. Think of it like a small business trying to make it big in the corporate world. Now let's get straight to the money. The report shows a net loss of over $692,000 for the year ending March 31, 2025. That's a pretty big jump from the previous year's loss of about $39,000. It seems like things are actually getting worse, not better, financially speaking. They brought in about $36,000 in revenue for the year. That's not a lot. To put it in perspective, that's less than what a single small business owner might make in a good month. And last year, their revenue was even lower, just about $577. So while revenue did go up, it's still so small, it's practically invisible. While they're trying to make more money, their costs are sky high. Their operating expenses jumped by about 38%, hitting over $428,000. This is driven by things like press release costs and marketing, which is understandable for a company trying to get noticed. But when your revenue is tiny and your expenses are growing, that's a recipe for even bigger losses. Let's look at their working capital, which is basically the money they have available to run their day-to-day business. They have a working capital deficiency of over $1.3 million. This deficiency actually got a lot worse compared to last year when it was around $713,000. Having a big deficiency means they might struggle to pay their short-term bills, which is never a good sign. Their cash used in operating activities was pretty high too, over $373,000 for the year. This means they're burning through cash just to keep the lights on, and it's more than they burned last year. Where did they get the money to cover these losses? Mostly through financing. They brought in over $390,000 from financing activities. This usually means they are borrowing money or selling more stock. This is a common way for struggling companies to stay afloat, but it's not a sustainable business model if they don't start generating their own income. Now, this is a really important part. Their own auditors flagged a major issue. They have substantial doubt about whether the company can continue operating. This is because they've had losses since they started and are relying on others to fund them. This is a huge red flag. It's like the doctor saying you need to make some serious lifestyle changes or you might not be around much longer. They've also got this deferred business acquisition cost of over $61,000. This is money spent on a plan to buy another company, but the deal hasn't closed yet. It was supposed to be finalized in late 2025, but it's still up in the air. Deals falling through can be a big drain on resources. Their main asset, besides cash, which is very little, seems to be software. It's listed at over $211,000, but it depreciates over time. So even their assets aren't growing. Their liabilities are dominated by convertible notes payable, which are basically loans that can be turned into company stock. They owe over $1.3 million in these notes. The interest on this debt is really high and they're showing a significant loss on convertible notes each year. This means the cost of borrowing this money is eating them alive. For example, the interest expense alone was over $316,000 loan. Was over $316,000. Looking at their stock, they've got about 37 million shares out there. They authorized a massive amount, 75 million shares. This allows them to issue a lot more stock in the future, which can be good for raising cash, but also means existing shareholders' pieces of the pie get smaller. And here's a kicker. Their own management admits their internal controls are not effective. They have issues with separating duties, assessing risks, and clear written policies for accounting. This is common in smaller companies, but still a concern when it comes to trusting their financials. Now, let's talk about the people running the show. Christopher McEachney is listed as Director, President, CEO, and Treasurer. He also seems to have resigned from some of these roles earlier, and Marisha Reynolds is also a key figure, holding titles like COO, President, Director, and Secretary. It seems like a small team wearing many hats, which can be both good for agility and bad for oversight. It's interesting to note that a significant chunk of ownership, over 52%, seems to be tied up with Noise Comms Limited, and the COO of Caro Holdings is apparently the sole shareholder and director of Noise Comms. That can create potential conflicts of interest. So what's the story here? Caro Holdings is clearly in a very early stage of development and is burning through cash to try and build a business. They have very little revenue, high operating expenses, and a massive deficit. Their auditors are even warning that the company might not survive. The strategy seems to be focused on B2B, B2C, and D2C solutions, using technology and AI. They even reference a recent AI automation framework. However, the financial reality doesn't match this futuristic vision yet. Their heavy reliance on convertible notes with high interest and loss recognition is a significant financial burden. The good news, if you can call it that, is that they are actively trying to pivot and grow as seen with their planned acquisition and focus on tech. But the risks are enormous. They need to drastically improve their revenue generation and cut costs if they want to avoid going under. The lack of effective internal controls also adds to the uncertainty. It's a bit like someone trying to build a rocket ship with very little fuel and a lot of debt. The ambition is there, but the execution and financial backing are seriously questionable. For investors, this is a very high-risk speculative play right now. They're essentially betting on a complete turnaround and a successful product market fit that hasn't materialized yet. Alright, that's our breakdown of Caro Holdings' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And hey, if you want to chat more about these filings and get more insights, come join our Discord community. The link is in the description below. Thanks for watching. See you next time.